March 2020, the world stopped breathing. The S&P 500 collapsed 26.2% at its lowest point. Liquidity evaporated. Fortunes built over generations turned to dust. News anchors scrambled to explain the inexplicable and fell back on the same tired excuse they always do. Nobody could have predicted this. Welcome to the Black Swan, an event with three defining characteristics. It sits outside all normal expectations. It carries a colossal impact. And human nature, true to form, invents justifications afterward to pretend it was predictable all along. Here's what they never told you. Financial disasters are not failures of the system. They are the system. While the world was losing everything, a small group of investors was smiling. Not because they got lucky, because they had a protocol. To understand how the elite survives, you first need to understand how you were engineered to fail. Wall Street banks and the suit-wearing managers running your pension fund operate under a near-religious dogma, the normal distribution, the bell curve. They call this mediocristan, a statistical utopia where fluctuations are contained and volatility is controlled. In these mathematically elegant models, stability is the rule. A catastrophic event, a 10 sigma shock, should occur once every several billion years under the bell curve framework. But financial markets don't live in mediocristan. They live in extremistan, a domain governed by fat tails, where a single extreme observation can disproportionately destroy an entire system. Call it the great illusion of safety. Traditional models, like the infamous value at risk, VAR, focus on a confidence threshold, but they are completely blind to the severity of ruin beyond that point. VAR tells you when you might lose. It never tells you how much you can lose when the unthinkable actually happens. The impossible happens far more often than the market admits. Crises that should occur once a millennium happen every decade. When panic hits the system, high-frequency algorithms that provide liquidity simply shut off, creating a terrifying vacuum and triggering flash crashes. The financial elite knows the academic models are, in the words of mathematician Nassim Taleb, a great intellectual fraud. Wall Street giants ignore reality to sell safety to the public, but behind closed doors, they use hidden strategies to capitalize on the market's myopia. Where the herd sees order and predictability, the elite sees fragility. And where there is fragility, there is a monumental opportunity. Meet Mark Spitznagel, an investor who started trading on the Chicago floor at 16, and who today runs one of the largest doomsday machines ever built, Universa Investments. Spitznagel founded Universa in 2007 with Taleb as scientific advisor, a partnership they had already tested together at their previous fund, Empirica Capital. Universa is a tail risk fund. Their goal is not to beat the market on sunny days. Their goal is to profit from the apocalypse. They have mastered a concept Taleb calls anti-fragility. Resilience means you absorb shocks and remain the same. Anti-fragility means the opposite. The system doesn't just survive disorder, it feeds on volatility, on fear, on systemic panic. It gets stronger. Their method demands a psychology of iron. They call it controlled hemorrhage, capital bleeding. The fund accepts small, calculated losses every single day, month after month, like paying insurance premiums. Spitznagel once compared this to playing the piano for 10 years, knowing only chopsticks, sustained entirely by the unshakable belief that one day you will wake up and play like Sergei Rachmaninoff. When the market collapsed in 2008, Universa posted returns of over 100%, catapulting its assets from a modest $300 million to $6 billion in a single year. When the COVID-19 panic wiped out trillions in March 2020, Spitznagel wrote to his clients reporting a return of 4,144% on the fund's tail risk strategy. The beauty is not just in the shocking numbers of the fund alone, but in the effect on the total portfolio. Spitznagel recommends allocating only around 3.33% to Universa, and the remaining 96.67% passively into the S&P 500. During the carnage of March 2020, while traditional markets were sinking, this hybrid portfolio posted a positive growth rate of 0.4. Controlled hemorrhage ensures that on the day the world burns, you are the only person with water to sell. How exactly does this protection operate inside the financial machinery? No sorcery, just pure cold mathematics through derivatives called put options. Think of them as fire insurance for your net worth. During calm periods, when markets are fat and greed rules, implied volatility collapses. The market, trusting its broken Gaussian models, prices catastrophic risk close to zero. Consequently, this fire insurance, deep out-of-the-money put options, costs mere pennies. You buy these contracts systematically. Month after month, you lose those pennies. Controlled hemorrhage. Then the anomaly strikes. During a Black Swan, correlations between assets spike to 1. Gold, bonds, equities all fall simultaneously, destroying the myth of traditional diversification. Volatility explodes, and the mechanics of options pricing accelerate violently, driven by sensitivity measures like gamma and vega. The value of your penny insurance policy doesn't just double, it multiplies non-linearly. This is asymmetry in its purest, most lethal form. A convex instrument. You lose a little in the normal direction, but gain exponentially more in the opposite direction of the same magnitude. As Universe's philosophy puts it, fire insurance that doesn't just rebuild your house, it pays you the value of an entire empire while the house burns. The same convex logic extends beyond Universe's specific protocol. While the 3.33% split is Spitznagel's operational recommendation for equity investors, Taleb generalizes this mathematics into a broader philosophical framework, the barbell strategy. Instead of being moderately risky and exposing yourself to hidden black swans that banks label as safe, you allocate 85 to 90% into maximum protection assets, cash or ultra short-term treasury bonds. And the remaining 10 to 15%? Hyper-aggressive, maximally leveraged bets on options. The risk of total ruin is 0. If the bet fails, you have 90% intact. But if the convex bet explodes, the total return dominates the portfolio. Extreme risk management doesn't end on Wall Street trading floors. The true financial elite extends this anti-fragility to the architecture of their own lives. They build what I call architectures of invisibility. What's the point of protecting your portfolio from market evaporation if it can be seized by political instability, predatory litigation, or banking failures? The top 1% shields their capital in offshore fortresses, jurisdictions like Nevis or the Cook Islands, operating under one supreme maxim: own nothing, control everything. Their assets are shielded inside trusts and LLCs that require criminal levels of evidence and millions in legal fees just for a creditor to initiate a claim. The final lesson of dark finance is harsh and unforgiving. The retail investor, deceived by TV advisors and financial influencers, plays a game where he loses slowly every day to inflation, or loses everything in a single day of panic. He wastes his energy trying to predict the future. The major players don't predict black swans. They know that timing a crash is a fool's game. Instead, they focus entirely on preparation. They build systems that cannot be broken by storms, ships that rise higher the stronger the tide. Real financial sovereignty is not about picking the right stock or calling the next bubble. It's about understanding the mathematical flaws built into society and positioning yourself to capitalize on them. In this ruthless market of predators and the preyed upon, wealth is not just what you earn, it's what you refuse to let the system take from you.